Alright, so this next section is I'm going to jump around a bit, um, just because there's a lot of, it's not easy to continue doing study after study. So, let's go to this one. This is, I guess it's a little bit more applied. This is selecting the best stocks using position sheet and barometer. But before I go that, understand what the barometer or position sheet is. Position sheet is really a watch list, but it's a modified watch list. What Wyckoff did was keep 100 active stocks, active leading stocks, or at least that's what he recommends. And they're in positions 1, 2, 3, or 4. Basically, it's either rallying or marking up, marking down. Okay. Position 1 and 2 are bullish. 1 is a bull rally, 2 is markup. Position 3 and 4 are bearish. 3 is a bear rally, and 4 is markdown. Alright, so what you're doing is you're putting the stocks in one of these categories or adding that attribute to the stock. And what he does after that is just tallies. Okay, out of these 100, you might have, say, 60 in markup and let's say 70 in markup and then 30 in markdown or something like that. And the ones that are marking up, you might have 35 of them that are also in position 1, which is a bull rally. So all you're doing is categorizing them, and then what he does is that he just charts this data. He tabulates this data in a table, and what it does is it confirms two things. One, the position of the overall market. So his judgment on the market is accurate because it's supported by its components or the leading active stocks. So if you see the S&P in a markup, he will confirm that with stocks like Apple, Facebook, Boeing, and United, and the banks, and tech, and all that. So it allows him to confirm the movement of the market with the movement of leading stocks in that market. So that's the first thing, confirmation, top down and bottom up confirmation. Second thing is he's going to see the switch between strength to weakness and weakness to strength. And sometimes it's not obvious in the market itself, but it'll be more obvious in the stocks. So all of a sudden, you had 90, not 90. Let's say you had 75 stocks in markup. You'll see that all of a sudden they're 20 in markdown. And instead of 75 in markup, you have 50 in markup. So now you're thinking, what the hell? It goes from markup, 75 of them being in markup, to say 55 in markup, and 20 have now entered the markdown phase. So this gradual rotation is captured by the position sheet data table, which is then graphed, and that graph is what he calls a position, a barometer, a trend barometer. So I'll be implementing all of these things step at a time, and you'll see what I do. Anyway, so right now we're going to this section where it's talks about selecting best stocks, the position sheet, technical barometer. There are two processes of reasoning by which we may arrive at a conclusion. One, oh no, not this again. All right, so this is what that's all about. All right, so I don't know if I want to go over this. Uh, that's basically what I just discussed. There, we'll go to this one. Alright, so the position sheet described in section 18M. How it's supposed to look, this is how it's supposed to look. Where is it? He wrote too much. This is how it's supposed to look. This is supposed to be a position sheet of 100 active leading stocks, and you'll see how I implement this. And then when you chart, you tally them. When you tally them, you get a table, and that table you get here position 1, 2, 3, 4. 1 is your rally, 2 is markup, 3 is a bear rally or bear pullback, right? 4 is your markdown. And what you're doing is, like, based on the date, you're identifying the number. So on the first, we'll take a look at how many are in markup. On the first, look at this, 149. 12 days later, 111. What happened? Some problem happened, because if you look at markdown, it went from 10 to 18 12 days later. So you see the gradual shift of markup declining. See that? Markup, stocks in markup is declining, and stock in markdown is increasing. So as the components go, so will the market. So you just have to see the S&P now and see if that S&P is confirming this. And if the S&P is still in markup while the stocks, individual issues, are continually increasing in markdown, that is a divergence. What that means is, what they're doing is they're just supporting some groups that are strong enough to move the average up, while it's being held up by the averages in certain groups that are being shown to have strength. The rest of the market is being distributed and marked down. So you're looking for that divergence as a caution, okay, as a warning sign, because this should match, the component should match the index should match the component. Anyway, so this, all of that is then plotted here, and this is just nothing more than chart. This can be easily done in Excel. You just tabulate those numbers, and those numbers will do all the graphing shit for you. So you have 1, 2, 3, 4, and actually you can clearly see that. So usually what would happen is, like right here, as was it position 2, so watch position 2. I can't find 2. Oh, here it is, 2 and 4. These are markup and markdown, or what he called advances up and advances down. And you want to watch them. Like when the market moves like this in the markup from here to here, this is very interesting. But like I'll go into the selection of them. But basically, you want position 1 and 2 together. That can really, because basically you're trading a rally within trend. And 2 and 3 and 4 would be also a rally within a downtrend. If you trade 3 into 2, it's basically a counter, you see reversion to the mean type trade. Yeah, I don't want to confuse everyone, so let's just move on. Anyway, moving on to the next one. Alright, so the position sheet described in 18M requires a determination of the technical position of the stocks. He says the minor moves can be best judged from the vertical charts. The figure chart, being less sensitive, is apt to develop indications of pending minor move sluggishness, or too late for you to anticipate the actual turning point. So 1 and 3, which are what? Rallies, turning points within rallies, should be determined for from vertical charts. 1 and 3 are rallies. 1 is bull rally, 3 is bear rally. Primary, so again, when we're judging position 1 and 3, we're looking at the vertical chart. On the bull side, position 1 must indicate the ability to develop a minor move up. This may be in the nature of a rally from a low point. So let's write this down. There's my. Can never ever. Okay, I'm back. Let's see, on the bull side. So bull, basically just position 1. Alright, so what's the criteria for position 1? Position 1 criteria, position 1 is first of all nothing more than a bull rally. Alright, so in order to get into position 1, you have to give an indication. What indication? It's a rally from the low. Okay, so a rally from the low. Alright, that's good to know. 2, a level where the minor move is the forerunner of a large advance. What? A level where the indicated minor move, it's just a pullback to support. This guy be pulled back to a support level. So basically he says that at a level, support or resistance level, where the indicated minor move is the forerunner of a large advance. Well, okay, we'll see about that. At a level in a trading range where the stock by its own actions indicates the probability of a small move up through the previous tops of the range. It's going to be a little tough. Basically, level in the trading range where the stock, where a breakout is expected. I don't know why it doesn't say move up through the previous stops of the range. That's called a breakout. In order to get position 2, this guy's gonna write rocket science. Position 2 is markup. So he said downward movement where it gives evidence of being under accumulation. So basically accumulation. And 2, a period of rest following a previous advance where it gives evidence of absorption. Yeah. Three, is no 3. Position 3 is the same thing, I think in the opposite. Okay, so in the nature of the reaction from a high point at a level where the indicated minor move is a forerunner of a large decline, at a level in the trading range where it shows the inability to rally and thus indicates, let's write this down then, position 3 is reaction from a high point, just a pullback opportunity. Okay. Alright, so I'm back. A lot of phone calls. Anyway, so basically position 1, 2, 3, 4. 1 is when you have a bull rally. So when do you get that bull rally? You get it from a low point. Low point can be trend or counter trend. Alright, so meaning it could be rally, pullback, and that's your low point. Or it could be rally in a downtrend and it's ready to rally up, pull back upwards. So the second one is a support level where the indicated minor move precedes a large possible advance. So this, I don't really see this as more different than a test. You have a rally, a pullback, a rally. So that prior pullback is a support level. So a retest of that level. Finally, the ability to go low in a trading range. So what you'll see in a trading range, you go sideways, and all of a sudden the bars are making higher lows on the right-hand side. Alright. Position 2, accumulation, reaccumulation, aka absorption. Anyway, all of this is, these are the definitions. Okay? So markup, markdown, you all know what that is, and obviously what precedes markup, markdown, accumulation, and distribution. So that's very straightforward. The redistribution happens like typically, it's like, there's a lot to it, but I have like at least 2 models in my head, and I don't know which one to explain. But if you see Apple, that is distribution, but I'm confused about which where it would go, because it's distribution, but the way it did it also is it was hugging the lows, so nah, it would fall under distribution. Anyway, so the idea is to get comfortable with 1, 2, 3, and 4, and that's what this study is going to be all about. So understand the criteria for each position, and that will help you to categorize the current state of your market. And by the way, this is not just for stock. Like any one of these can be applied to futures, forex, and any other commodities. It's very simple to do. I don't mean simple to do like it's not simple to do, but it's applicable to all markets where you have pressure and support and buying or sellers. Anyway, in order to get into position 2, blah 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 blah. In brief, we assign a number 1 or 3 position to a stock whenever our judgment of the behavior leads us to anticipate a small move up or down. Anticipate a small move up or down. That's the critical thing here. La 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 la. 3. Anticipate a small move down. Anticipate a small move up. When do I anticipate a small move up? Obviously on a reaction, when it's reverting to the mean or something like that. And also probably on the test. Alright, so let's continue. 2 to 4, whenever our analysis leads us to anticipate a large move up or down. It is important to know that position 1 may build up into 2 and position 3 may build up into 4. This is very important. Like sometimes you see it all the time. Like a lot of folks think that this is just a pullback when it's not. Alright. The other thing is, when you're prepping a market, like to understand it, you have to know what phase it's in. If you don't know what phase it's in, you can be screwed. So you have to know what phase it's in. Like Apple right now, for sure is in the markdown phase, because all the elements of distribution, even hypodermics, the distribution, the holding of the range, so they complete their distribution, the breakout, high volume, all of that, everything is there. So for sure, it's in markdown, and guys who are going to go long in Apple as of this date today, they're gonna be taken to the woodshed. However, even though it's in markdown, it's so oversold that it can easily react to a higher level, because it's been slammed, like it's straight down. There's no corrective rallies in it, or they are like 1 or 2 bar, but there's no retracement. So although it's clearly in the markdown phase, at any moment it can rally, a bull rally can occur to test higher levels. That's the position that it's in. It's markdown, severely oversold, because it just keeps on down without the ability to, the reactions are like very minimum. So anyway, it may be necessary to cancel and establish position 2 or 4, or change these positions to neutral, or transfer a stock from position 2 to position 4, and vice versa. But these positions should not be reduced to 1 or 3. For instance, suppose you have placed a stock in position 4 in the explanation that it will decline 23 points. So why did you put in position 4? Position 4 is marked down, so that's why you put it in position 4. And decline of 23 points is not a small move, it's a big move. So big move down, meaning decline of 23 points, and fits position 4 because position 4 is marked down. If it subsequently declines 18 points, do not reduce the originally established 4 position to 3, because the stock may have only 5 more points to go. Leave it in 4 until you have reason to believe that it cannot fulfill the original indication, or until the action becomes doubtful, when you should change it to neutral. This is the other point. Even though there are 4 position 1, 2, 3, 4, there's actually a 5th, and that is neutral. Alright? When it becomes doubtful, right here. Or if it accomplishes its objective, continue to let it stay in the original position until the stock's action otherwise warns you of a change in trend. The advantage of this last mentioned procedure is that should a stock merely go into a resting spell after it has attained one objective and then show that it intends to extend the original objective, your previously assigned 2 or 4 position will continue properly to reflect its possibilities. Bottom line, if it's going down and it's in position 4, continue to leave it alone because it's continuing to go down. If you think that the stock is going to go down 100 points and it goes down 80, don't change it until you get an indication from the price volume action that it's moving into another position. A neutral portion develops, as already explained, when there is no definite indication of a move in either direction or when there is doubt. This you're going to have many times. Doubt to the ability of a stock to move decisively either way. This may be when it gives tentative but not wholly convincing indications of having exhausted its rally. Having exhausted its rally. Or reaction. Okay. So position 5. Position 5. Neutral. Basically, these are the neutral position. When it's exhausted its rally and reaction, right? So you can move from 1 and 3 into position 5 when it's exhausted its rally or reaction. You're doubtful about whether it will rally or react further. So it already rallied. You don't know if it's going to go up or not. So it's doubt. Doubt enters the mind. Or you have possible change in trend. Possible change in trend. So that could be like when you get a climax. You get a climax and you have a secondary test or change behavior or something. You're like, oh shit, trend is turning. I don't know if it's going to continue going up or I don't know if it's going to continue going down. It looks like a possible change in trend. You have doubt. You have dullness. Doubt, overall doubt. Like when you just have doubt, you can't figure out what the hell's going on because of price and volume. I should write that. Clear. I say random behavior. Doubt or random. Dullness or it looks like random behavior. You can't figure out what the hell's going on. So, contrary to what most people believe, neutral position is important. It has advantages as fully as other positions because it is just as vital for you to know what stocks to avoid as it is to know which to buy or sell, to know when to stay out. This probably applies to day trading more than anything else. Because another call. Hold on. So anyway, what I was saying is that this applies to staying out. This is really important. Like market selection. Half the work has to do with, well, actually more than half, has to go with the right market, then the right time. Like most of the work is there. The selection of the market, then the selection of the timing. So you don't, if you just stick to a market without knowing all of these things, it doesn't work. Anyway, it is a mistake to suppose that you must be in the market at all times. It is wrong to believe that you must always be able to arrive at a bullish or bearish conclusion. There are times when the market is so, the stocks, you don't know what they're doing. To take a position when you are in doubt, certain loss. Where was I? Establish. In other words, do not run after stock if it should go away from you merely because you fear it will never again give you a chance to get in. Let somebody else take the risk of playing with the stock while you wait for the next opportunity. Basically, don't chase. Okay, most people take positions merely because they think they are missing opportunities because they fear the market will get away from them. This is really a very important statement, and I strongly suggest folks read that book by Douglas and really try to understand it, not just peruse it. Where he talks about all the different fears: FOMO, fear of loss, fear of being wrong, and fear of leaving profits on the table, and where they originate from. Position those who. There are situations which make it impossible for anybody to seek out seek the outcome with certainty. Nothing clears the mind like a shift to a neutral position. Alright, finally, I'm going to get to page 8 and 9. So let's put this to the side. Move this right here. Okay. Alright, so now I'm going over the study. Turn to page 8 to 10 of section 9M and reviewing the connection. What is this? Connection therewith? We will see the stock is in a neutral position during the first 2 weeks of the 2 weeks of the movement recorded on the vertical chart. What's he doing? Page 1. Fuck. Alright, so first 2 weeks. So he's referring to this base over here. It is neutral because as of yet we have no clear indication of either direction. So if I show you this base, right, 1, 2, 3, 4, 5, 6, 7, 1, 2, 3, 4, 5, 6, 7. Okay. Do you see anything? Yeah, there is springboard, but anyway. Basically waddling back and forth between 30 to 34. Alright, so between 30 and 34. When it rises to 35 and a half, which is right here, right, we have some basis for formulating a conclusion. Thus, we note that the price has now risen steadily, and there's an increase in volume. Alright, I'm going to start working through this. So you have increase in volume. And you have buying climax. Then you have confirmation. Okay, so what happens is right after the buying climax, you have wipes out the entire day's gain and closes near the low. We therefore conclude that it's ready for reaction. Okay, so it's ready for a reaction. So what is a reaction? Reaction is either position 1 or 3, right? So this is a bear reaction. So at this point here, it's in position 3. So let's go here again. The following session seems to confirm this. After making fractionally higher top, the price wipes out all of the day's gain and closes near the low. Okay, so right there, it's on position 3. Alright, so we'll put the fucking position 3. Okay, and where? Right there. Okay. And that's the reasoning for it. So at that point right there, it's in position 3. Okay. Why? The bar before it was climactic, as you can see here, right? Climactic. You see the increase in volume. That's the biggest in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 sessions. And it's at the top. And then after that, the move goes fractionally higher, has a low end close, and takes out the day's gain, meaning from low to high goes right back down. So that bar is, he calls it like kind of like confirmation, right? Anyway, so with that quote unquote confirmation bar, we add confirmation bar after climax sets up a reaction. That's position right there. The stock is in position 3. All right. And I could use rail charts, by the way, to show how this can be applied right now in the SPY. Like I know exactly where this is occurring in the SPY, at least in 2 spots on the latest swings in the SPY. So all what you're seeing here can be applied right now, not 10 years from now, but right now. So now we're looking for it a halfway back move to about 32, right? And we really want at least 10% shrinkage in price. So why does he say tentative and not like whatever? He says, accordingly, we may reflect this expectation by placing a stock tentatively in position 3. We may put it in that position, but not positively, because of the amount of distance that it's going to cover. As you can see over here, how much distance is there? Right? He says, we put it in that position tentatively but not positively because we have insufficient evidence to judge how much it might react. A normal reaction would be about 32, halfway back to 30. Why? It rose from 30 to What are we going to? 32, like 30. Oh, fuck, let me read this. 30 to about 35-ish or 36. I don't know. 30. It's about 4 points, about 36. So I would say about 33 would be normal. He's saying it would be about 32, halfway back to 35, because maybe it didn't make 36. The 1 point chart at CD show a line of two 34s. Over here only shows a line of two 34s. You see? That's only two 34s. Right? Gosh. Such a pain. Let me go here. Oh, there it is. So that shows line of two. Only two. Count is only two. Okay, 234s. So shows a line of two 34s, which confirms this. Why? Because 2, take away 2 from 34, you get 32. But to get to a definite 3 position, we should have grounds for at least 5. So it's only going down 2, but you want it to go down at least 5. And preferably 4 points. 4, since the latter would fill our requirements of an approximate 10% shrinkage in price. I don't know what he's talking about, but I guess he has a requirement for 10% shrinkage. Anyway, so the thing here is the cause here, the cause is only 2, not 4 or 5, and we have a requirement is at least 10%. So the minimum move should be around 32, I think. I don't know, about 32 or whatever. So it is in a tentative position 3. Okay. All right. So what does that mean? It means, let me put it all together. Move went from 30 to around 35 or 36. All right. But the count is only 2 points at 34. So we expect a reaction to go down to 32. 34, 33, 32. Right? 32. And what is he saying? He's saying that even if it goes down to 32, which is halfway back, it's not good enough, because the minimum requirement for our reward is 10%. So it needs to go more than 2 points. 2 points is 10% for a $20 stock, but not for a $35 stock. Alright, it has to go much more. So there's 2 ways to do this. He has a requirement for about 10% shrinkage in price, and I guess that doesn't fulfill it. The other way he does it is by doing a set amount of points, which is 5 points. 5 points, he was just using 5 points. But the real requirement is you must have at least a 10% move. So $100 stock needs to have an objective of at least $90. If it has an objective of $95, it's not worth to short. because you need at least 10. You need that 10% in your pocket. After completing the, okay, I'm gonna stop right here, but understand like the material here so far. You have a rally. You catch the top of the rally is climactic and confirmed by the immediate reversal that wipes out the gains of the climax bar. At that point, you take a look at the figure chart, which shows a 2-point cause. So the move is expected to go to 32. Now you consider putting this stock in position 3 because it's ready for reaction, as indicated by the climax and the lack of follow through, aka the confirmation bar. But the problem is you need a significant move down of at least 10%. It's not giving you 10%. It's giving you 2 points. It's supposed to give you more. I think at least 4 points. That would be about 10%. It's around 4. But it's only giving you 2. So it's not good enough, and because it's not good enough, you put it in position 3 tentatively and not positively. If this cause was bigger, like 4 points or 5 points, then this would be positively in a position 3 because it would indicate a nice move down of at least 4 points, but it's not there, so it's only 2 points that we can see as indicated by the two count. So what are you going to do? You put it there tentatively. Okay. After completing a more or less expected normal reaction to 32, the stock shows that it's still a weak technical position. I'm going to stop right here because it's getting long. Again, we're on this 19M, so get your asses to read this shit, and because I'm going to be moving on to doing real Wyckoff, like applied Wyckoff, which is nowhere on the internet because none of these guys do it. I don't know why, but or maybe they do it but they don't put it on YouTube. So anyway, but I'm going to start applying this on actual markets. So take care, happy Thanksgiving, and happy holidays.